Hi, I'm Jimmy. In this video, we're looking at Adcore, ticker symbol ATKR. So Adcore is a stock that was recommended to me in our private investing community. And as I've done the research on this company, I've realized this is a really impressive company. I'll show you in a minute, but this is a company that smoked the S&P 500 over the past decade or so. And it's been real interesting company to research, especially because over the past year or two, things haven't gone quite as well for them. And I think that could be a good opportunity. Now, throughout this video, we're going to be using a website, investorsgrow.com. This is a website that we built that helps us analyze companies, value companies a bit quicker, things like that. We also, if you sign up to get access to this website, you also will get access to the private investing live streams we do, the private community. It's really good over there. If you're curious, link in the description below. But for now, let's jump into some of the basics of Adcore business, and then we'll jump in and try to understand some of the numbers, what's happening, and ultimately, what's this company really worth today, and should we add it to our investment portfolio? So, as you might guess from this picture here, well, Adcore makes things tied to the electrical industry. Particularly, they focus primarily on non-residential construction. So they have a lot of different products that, in theory, if you were building, let's say, a giant office building or something like that, well, you'd use a lot of their products when setting up the electrical work. Now we jump over and look at the distribution of their revenue over the past year. Well, we can see about 3/4 of it was tied up in the electrical segment, and the rest was tied up in safety and infrastructure. Now, to better understand, as I was researching this company, I tried to get an understanding of kind of their growth and are they truly trying to grow, and how is that translating to some of the numbers? So I went back to different annual reports and I was able to kind of put together a timeline. So this is a company that went public in 2016, and in 2017, 2018, they introduced some PVC conduit products and they started to expand into new markets to try to offer some new growth opportunities. In 2019, they started creating products specifically geared towards targeting data centers. Well, roll that into 2020, the year of COVID. They came out with some new electrical raceway products. 2021, they started to focus a bit more on the digital side. Think smart products that, in theory, you could have different electrical components in a building connected to an app or connected to some sort of platform where you can manage and get real-time updates on what's happening with the building that, whatever the contractors are building. So I think that particular one that they push out in 2021 and continue to push today, I think that has a lot of long-term potential. There are other competitors in the industry doing very similar things, but I was happy to see in my research that Adcore was also going down that line. When we jump over to 2022, they introduced some advanced conduit systems. And then 2023, they really reiterated focusing on higher margin products, data centers, infrastructure products, things along those lines. So since they've gone public, they have done a fairly good job of pushing out new products and trying to expand their market. And this should lead to higher revenue over the long run. Now, you might ask, why was I so concerned about the revenue growth of this business? Well, that is because this business is very much a cyclical business. Now, just so we're all on the same page, when we think cyclical business, think the growth of the broader economy, not the growth of the stock market, the growth of the broader economy, often measured by GDP. So when we jump over to a long-term chart of the GDP of the United States, this is the growth rate, year-over-year growth rate of GDP. And essentially, the thing that, it's kind of a lot of up and down, mostly above zero, which is good for long-term growth of the US. But basically, the way to look at this is that the US economy runs in sort of swings. Not as cleanly as this green line, but I think we get the point. Sometimes the market goes up, not the market. Sometimes the economy goes up, sometimes it's weaker. Sometimes it's stronger and weaker, and it kind of keeps going. Now, it can be declining, something like, let's say, this decline here. Well, it can be declining, but also be positive. It could be above one, but still declining. So I just want to keep that in the back of our mind, because now when we jump over to their revenue, well, we can see that overall things looked a bit flat for a while, but then revenue started ramping up. But there's another chart on the website that I think helps tell the story a bit better, and that is revenue growth. So this is a chart of revenue growth for Adcore over the past decade. And we're really going back to 2012. And the thing that I think is most interesting here is if you look at it, and I get we're doing this roughly, but if we were to look at it, doesn't it kind of look like the swing of the economy? Which is exactly, this is a cyclical company. If you ever hear a company, they say, oh, this is a cyclical stock. This is a cyclical stock in that growth is better when the economy is stronger, growth is weaker when the economy is weaker. And it's kind of that simple. But over the long run, over a long period of time, let's say 10, 20, 30 years, well, as long as they stay mostly above zero, there should be mostly positive growth. Now, we can see a very similar thing when we jump over and look at net income. Net income is profit. And you might notice this chart looks very, very similar to what we saw in revenue. And when we look at this chart, I think it makes a lot of sense to actually split this into three different sections. The first section, this is actually before they went public in 2016. Well, we could see that net income was negative. A lot of companies, smaller companies, right now this company is only a $3.5 billion company, which is where partially I think the opportunity is. But also we can see here that early on, younger companies, smaller companies, wasn't profitable. Very common. And then they kind of started to go profitable, which is good. It was gradually drifting higher with a little bit of volatility like we saw in the growth chart. But then over the past couple of years, as we could see, things went a bit nuts. Well, the stock also went a bit nuts during that. And the real question that I started to ask was, well, what happened in this time period? And then what happened here that revenue ramped up as quickly as it did? And then you know what? Just as quickly as it ramped up, it started to pull back. So I really started trying to dig into this and understand why it went as nuts as it did. And I think one of the reasons, maybe not the primary reason, but one of the reasons is declining demand. So as I mentioned at the start of this video, Adcore is very much tied to non-residential construction. Now, in the United States, where they generate most of their revenue, non-residential construction is by and large growing, much like GDP. It continues to grow, although not always smoothly, not always evenly. In fact, if we jump over to a chart, an index that tracks the growth of non-residential construction, again, just like we saw with GDP year over year, well, we can see we kind of have that same cyclical style that we saw with GDP. And if you think about the ramp up in 21 and 22 for Adcore, well, what was happening? But the industry, their primary focus, the primary industry that they sell electrical products to, that thing was ramping up. Since then, it started to pull back, which would partially explain the pullback in demand as the industry started to pull back a bit. Now, I will point out that this was a relatively small, it was relatively, let's say the percentage decrease in revenue was partially due to lower volumes. But the decrease in volumes was relatively minimal compared to some other things. Well, let's put it this way. The decrease in volume was somewhat responsible for the decrease in revenue, but not completely responsible. In fact, a far bigger contributor to both the giant jump up that we saw in revenue, followed by the pullback, was really driven by the price of their products. So this is a chart of steel. Steel is one of their inputs. It's one of the costs that they pay. This is raw material for them. They buy steel, and the higher the steel prices are, well, if they are in a good business, they, in theory, pass those prices on to the customers. If they can't pass the prices on to a customer, that's a real problem because margins get squeezed there. But they were able to pass those prices on. So in 21, 22, well, we see a ramp up in steel. Now, this isn't their only input. We'll look at some others in a second. But just like we saw in the non-residential construction, there was a ramp up when revenue was ramping. And then when revenue started to decline, we saw a decline in prices as well. Now, this is very important because ultimately this means that they were able to drive their prices up. Imagine they were selling 100 widgets for $10 a piece. It's $1,000 in revenue. If prices go up and they have to sell those same 100 widgets, but now they can sell them for $15 a piece because their prices went up. And you know what? The whole industry's prices went up. So the customers really have to buy them, if they want to build their buildings and whatnot. Well, if it goes from $10 to 15, well, revenue for the company goes from 1,000 to 1,500. That's a 50% increase. And the numbers can look fairly fantastic. But then if we see a decrease here and your competitors are dropping prices, they're kind of forced to drop prices as well. Just like that, we can see a fairly big pullback in revenue. We'll come back to this in a second, but just to kind of continue this story, this is the price of copper. As you might guess, copper is a fairly important input for a company that makes electrical stuff. This is a fairly important input for them. Again, a raw material cost. And just like we saw before, 21, 22, prices were higher. The prices didn't jump quite as much as steel, but I wanted to point out that they were higher, and they were higher than they have been over the past decade, pretty much. Now, since then, the numbers have pulled back some, although not as much as steel. But again, this is happening pretty much across their board. So when we jump back to their revenue, across the board, numbers were increasing, and they appear to be heading in the opposite direction. Now, I think this is where our advantage could come in. With this kind of as the backstory, and we understand that this is the reality that this company lives in, I do not think it would be at all surprising if over the next year, this number continues to decline some. Now, I don't expect it to get as low as pre-COVID levels. So let's say 2020, 1.8 billion, something like that. I don't expect it to get down that low. But I do think that if 2024, I do think 2024 will be a down year. And early quarters for 2024, by the way, their fiscal year ends in September, as you can tell at the bottom here. Again, the website points out what the fiscal year ends. And here ends in September 2020, September of every year. So September 2023 was the last fiscal year. The first three quarters are down. The fourth quarter is the final quarter they have to report. And then fiscal year 2024 will be done. But revenue numbers will be down. When we jump over to profit numbers will also be down. I think that there's no reason to believe that profit won't also pull back. But again, I think it's going to be above when it settles off and starts heading in the other direction. I think it will be reasonably above the 152 million that they saw back in 2020. Okay, now with this as the backdrop, I think it's important to jump in and look at the fair value and is there really an opportunity here over the long run? Well, this is a chart from the website where this is Adcore stock over the past year. And we can see that recently, this stock is down a decent amount. In fact, you can see up in parentheses there that this stock's down almost 35% year over year. So clearly that's a bad sign. Now, I think partially this is due to the fact that people saw a giant jump. And if we don't do all the research, if we don't do a deep dive on the company, and we don't truly understand what is causing the drive higher and then the pullback lower, many investors might see the pullback lower, think this company is getting worse, even though it's kind of right in line with what they should be doing from a cyclical standpoint, or let's say what the whole industry is doing. Well, they see a pullback in revenue, a pullback in profit, they jump out and sell and perhaps oversell this thing. Now, one of the things that struck me as interesting when I was doing this research is what if we would expand this chart from a 1-year chart over to a 10-year chart? Well, this is a chart, again, from investorsgrow.com. This chart goes back the past, well, it's a 10-year chart, but there's a bit over 8 years because, like I said before, July 2016, they went public. And this goes up to, as of the shooting of this video, but we can see they're up about almost 500%, which is a fantastic return. So if we were to measure from their IPO date out until recently, and this includes the pullback, well, the compounded annual growth rate over this time period is nearly 25%, which is fantastic. But if we were to measure the S&P 500 from the exact same IPO date up until as of the shooting of this video, well, the S&P 500 is up about 12.5%, which means that this company, Adcore, nearly doubled what the S&P 500 did. And the thing I want to point out here is that is including the 34% pullback we saw in the past year. So this is where I think the real opportunity could be. If the consideration for me, for my personal investment portfolio was, Now that let's say they're out of favor, the market sold them off. I think overly sold them off. The market has sold them off. The company's pulling back, and that might continue. The idea of trying to catch a falling knife, I don't know if you've ever heard that phrase in investing. Basically, don't try to time the bottom. It is possible that over the next quarter, 2 quarters, 3 quarters, 4 quarters, this continues to drop. I understand it is possible. It is possible that the revenue continues to drop. It depends on the broader macroeconomic situation. Now, lowering of interest rates, if the Federal Reserve were to do that, that should be good for smaller cap companies. Makes money cheaper, makes growth cheaper. It allows them to make some acquisitions, allows them to expand abroad. It allows for a lot of potential opportunities that perhaps with higher interest rates, they wouldn't be there. So I think that AdCore looks real interesting, but we don't want to pay too much for it. So when we jump over to a chart of free cash flow, now these are the numbers that I'm going to use in my discounted cash flow calculation, again from the website. And here you can see that first thing I want to point out, small company, $3.5 billion company. On the Investors Grow website, we've got maybe about 5, 6, 7,000 companies worldwide that have analyst estimates covering them a ton. We got a ton. We got like 30,000 companies covered when it comes to revenue, earnings per share, things like that. But when it comes to free cash flow, a relatively small proportion of analysts cover, relatively small amount of analysts that cover companies also publish their free cash flow numbers. I guarantee most of them calculate it, but a lot of them don't share it. So the thing I want to point out here is that these bars are all blue. So if you are joining the website, if you see blue bars, those are computer calculations. You can tell that up here, or it says or it just says calculated. Those are computer calculations. Now, I put in the inputs to try to determine where the free cash flow numbers should start. I wanted, as you can see, I have a pretty big pullback coming off the last realized year, which was 2023, the dark blue bar, down to the light blue bar. I wanted that big drop. That is based off of my research, not analyst estimates. Now, what I was trying to do is I was trying to hold, let's say, the longer term trend intact and just assume that the giant spike up and the pullback was just because of some economic situations and, frankly, some advantageous pricing, which is what I think a lot of it was. And when I read through the not the analyst reports, when I read through the management reports, their quarterly statements, their management discussion and analysis going back the past couple of years, that's really what they attribute a lot of it to. I did check some competitors as well, and a lot of the competitors were singing very similar stories. So using these numbers, these free cash flow numbers, going out just 3 years, and then we take a perpetual growth rate of 2.5%. So we assume that they go out 3 years like this, and then it just grows at 2.5%. So I think that the numbers are fairly conservative. And with those conservative numbers, we get a fair value for this stock of about $143 per share. Right now, the current price is sitting a bit under 100. So we got about a 33% margin of safety, which for me is plenty good. I would want my margin of safety, smaller cap company, I want a little bit higher. For a company like this, 25% I think makes sense. 25, maybe even 30% makes some sense. But 33%, we're more than in that window. And again, I took hyper conservative numbers to get here. Now, perhaps we don't want to use my estimates for free cash flow. So another thing we can use on the website is their own historical PE multiples. So this is their PE ratio, the chart of their PE ratio going back for as long as they've been public. And basically, here you can see that the current PE ratio is 6.4x. Now that sounds super cheap when you think of the S&P 500 is trading at, their long-term average is like 19 or 20x. So it sounds cheap compared to that. But really, 6.4x for them, it's below their long-term average. But they don't seem like the type of company that should be trading at 20x. So I wouldn't use that as a comparison. But I do think it should be higher than this. Now, like I said, although not many companies publish free cash flow estimates for this company, by the way, I checked out Bloomberg Terminal. Even they didn't have free cash flow estimates for AdCore. But what we do have is we have analyst estimates for earnings per share. So that allows us to create a chart, something like this, which is forward earnings per share forward-looking earnings per share. And again, we can see that compared to the long-term average, which is closer to 10x, well, we can see that this stock right now, again, looks like it's fairly inexpensive. So there's multiple things pointing that, given their earnings, given their own history, well, it looks like this company could be undervalued. Now, let's go one step further. Say, well, what about the industry in general? And I was a bit surprised this, but Bloomberg publishes the Bloomberg Electrical Components and Equipment Index. And basically, this is the PE ratio for this is a trailing PE ratio, not a forward PE ratio. This is a trailing PE ratio for that index, which is the exact industry that this company competes in. And the average, the long-term average over the past decade for the entire industry is like 26x. Now, we can see at the very end here, it has started to pull back. Overall, I think this is a bit high, but I do think that as Adcore gains strength in the industry and continues to introduce new products, and so far, over the past, since they've gone public, they've done a fairly good job of growing, and there's no real indication that that will stop. Yes, they are partial victims, as the entire industry is. They are partial victims to the swings, the ebbs and flows of the economy. But as we saw from a stock market perspective, they have more than enough firepower to beat the S&P and potentially be big contributors to our personal investment portfolios. Now, I'm fairly comfortable with the estimates that I came up with for free cash flow. So in my mind, I'm going to stick with the discounted cash flow calculator calculation. This is a company that I want to add to my investment portfolio. I intend on adding it. But as many of you know who have been following this channel for a while, I don't like to buy it and then make a video on it. I much prefer to, before I buy it, make the video, and then I'll do follow-up videos after I buy it. But for now, this is my official way of saying I plan on adding this one to my portfolio, but I'll wait a few days before I jump in and buy this stock. So you guys have a chance to do your own research. Let me know what you find. Let me know if you find any kind of holes in the story, any interesting opportunities that could be there. I do agree that this company is facing some headwinds, let's say over the next 12 to 18 months. But I think over the next 10 years, this company has the potential to have some real fantastic returns, which is why I'm trying to add it to my portfolio. Now, if you'd like to sign up to get access to this website where you can analyze companies, value companies quicker and easier, join our private investing community, watch our private live streams, things like that, I will leave a link to that in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.